Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at NIO.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, please do. It really helps out the show.
Definitely. And before we jump completely into it, I just want to mention that we'll be using some charting tools today, specifically VIP Algos, to look at this setup.
Right, which is a great tool for this kind of thing.
Exactly.
Yeah.
We've got the link to VIP Algos right down below in the description if you want to check it out. But let's get into NIO, because I want you to imagine, like, you're sitting in the pit lane at a racetrack, right?
Okay, I'm picturing it.
And you're looking at the telemetry data for your star driver. The numbers on your screen are just unbelievable. The engine is perfect. The aero is flawless. They just set an all-time lap record.
Sounds like a good day at the track.
Right. But then you actually look out the window at the actual track, and the car is somehow moving in reverse. It's just sliding backward down the straightaway.
Total cognitive dissonance, yeah. The mechanics are pushing violently forward, but the reality you're watching is moving in the exact opposite direction.
Exactly. And that sliding race car, that is NIO right now.
Oh, 100%. It's wild.
Under the hood, this electric vehicle maker is achieving massive, like, unprecedented growth. But if you look at the stock market, their valuation is moving violently backward.
It really is a textbook case of market divergence. On one side, you have this undeniable fundamental reacceleration. We're talking booming sales, major production milestones.
Right.
But then, turn around and look at the chart and you see a stock that plummeted 25% over a recent 13-week period.
Which is just crazy to me. Because if their top-line numbers are climbing, logic dictates the stock should follow suit. Right?
I would think so.
I mean, I'm looking at their trailing 12-month revenue growth, and it's sitting at 48.182%.
Almost 50%.
Yeah. In an automotive landscape where headlines constantly scream about EV demand slowing down, almost 50% revenue growth in a single year just feels impossible. How are they pulling that off?
Well, the primary engine behind that surge is their new flagship model, the ES9.
Okay.
This vehicle just hit 10,000 deliveries in its very first month on the market.
Wait, really? Month one?
Month one. Hitting 10K in month one for a premium EV is not just, a nice PR stat. It is a monumental logistical achievement.
Because of the supply chain stuff.
Exactly.
Yeah.
Bringing a new car to market involves terrifying supply chain complexities. You've got tooling factories, quality control bottlenecks, all of that.
Right. It's a nightmare.
So getting 10,000 flawless units into the hands of paying customers in 30 days, that instantly validates their production capacity and, honestly, their ferocious consumer demand.
Contrast that with one of their main domestic rivals, Li Auto. I was looking at their numbers, and they saw their June 2026 deliveries fall by nearly 15%.
Yeah, that was a tough month for them.
So NIO isn't just growing. They're actively devouring market share while competitors stumble.
Exactly. They're taking a bigger piece of the pie.
But okay, you're painting this incredibly rosy picture of 10,000 ES9s rolling off the line. And I can't ignore the gaping hole in their balance sheet.
And margins.
Yes, the margins. Their trailing 12-month net margin is a brutal negative 9.09%.
Yeah, it's painful to look at, yeah.
It feels like a restaurant that's packed every single night.
Yeah.
Right? There's a line around the block for the food, but at the end of the month, the owner is bleeding cash because they, overspent on custom imported marble tables.
That's actually a great way to think about it.
If they're selling so many cars, why are they losing money?
Well, that negative net margin is the exact reason the stock has taken a beating. And your restaurant analogy hits the core of the issue. They're spending a fortune on the equivalent of those marble tables.
Right.
But the market often misinterprets why NIO is bleeding cash. It's not because the cars themselves are unprofitable.
They're not.
No, actually. Their current gross margin is a very healthy 15.7%.
Oh, wow. Okay.
Yeah, so the raw materials, the labor to build the ES9, and the sale price, that equation, is solidly in the green. The cars absolutely make money.
So the cash is vanishing somewhere between the factory floor and the bottom line. Where is it going?
It's being poured into aggressive research and development and, more importantly, the rollout of their battery as a service network, or BOSS.
Right, the battery swaps.
Exactly. NIO operates on a completely different paradigm than a company like, say, Tesla. They don't just build cars. They are attempting to build the entire fueling infrastructure.
Which is incredibly ambitious.
Very. Instead of plugging your EV into a charger and waiting 45 minutes, you drive into an NIO station. and an automated robotic system unbolts your depleted battery from underneath the car and swaps in a fully charged one.
And that takes what, like a few minutes?
The whole process takes about 3 minutes.
See, building a nationwide network of robotic swap stations sounds like a capital expenditure nightmare.
Oh, it is. It's massively expensive.
You got to secure the real estate, build the robotics, maintain a huge surplus inventory of batteries just sitting around waiting to be swapped.
Exactly. It is capital intensive to the extreme. But here's the thing. This isn't a failure to control costs. It's a deliberate, calculated moat building strategy.
Okay, walk me through that.
Think about the psychology of an EV buyer. The number one fear is battery degradation.
Right, like what happens to my phone after 2 years?
Exactly. What happens in 5 years when your car battery only holds half a charge? In the NIO ecosystem, you never care about degradation because you don't actually own the battery.
You just swap it.
You just swap it.
Yeah.
This creates incredibly high switching costs. Once a consumer relies on 3-minute battery swaps, they are never going back to a 45-minute plug-in charger.
That makes sense.
And that brand loyalty gives NIO tremendous pricing power.
I get the long-term vision, I really do. But a negative 9% margin is still a negative 9% margin.
Yeah.
How does selling more ES9s actually fix that if they keep having to build these wildly expensive stations?
It all comes down to operating leverage.
Okay.
Building the first 1,000 swap stations is obscenely expensive. Those are fixed costs. But once the station is built, the cost to operate it is relatively flat.
So as volume scales up.
Right. As more and more ES9s hit the road and use those existing stations, the revenue grows exponentially while the fixed costs basically stay the same.
Got it.
That 15.7% gross margin on the cars starts to finally overpower the infrastructure spend, and the operating leverage flips from negative to positive.
So the fundamentals really are acting like a coiled spring here. The business model works, the moat is deep, revenue is up nearly 50%, and the infrastructure is already built to handle the scale.
Exactly.
Which makes the chart even more baffling, honestly.
Yeah, it's a huge disconnect.
Because NIO's stock is currently trading around $4.78. That is a steep 40.4% discount from its 52-week high of $8.02.
Yep.
A 40% haircut on a company growing revenue by 50% just feels broken. How do analysts make sense of a market that's actively ignoring the company's success?
Well, they stop looking at the balance sheet and start looking at market mechanics.
What do you mean?
A stock price doesn't just reflect a company's current value. It reflects institutional rebalancing, macroeconomic fears, algorithmic selling.
Oh, right. The machine's just taking over.
Exactly. When a stock pulls back 25% over 13 weeks, it enters a technical breakdown phase. Momentum algorithms often take over and just keep dumping shares regardless of what the underlying business is doing.
So how do you even navigate that?
You use technical indicator tweets,
Yeah.
like the VIP Algos platform you mentioned earlier. You use them to figure out if the bleeding has stopped.
See, the idea of technical analysis has always felt a bit mystical to me.
A lot of people feel that way.
Just staring at raw price action and drawing lines on a chart. Like with VIP Algos, which is an educational TradingView indicator suite used across stocks and crypto, what is a tool like that actually calculating?
It's basically turning market psychology into visual math.
Okay, I like that phrasing.
Tools like VIP Algos visualize buy and sell alerts based on momentum. They map out trend directions, and they identify take profit and stop loss zones.
But how?
Well, momentum indicators aren't magic. They are tracking the rate of change in price over time. So if a stock is dropping fast, but the rate of that drop starts to slow down, an indicator might flag that the sell-off is losing steam.
Even if the price is technically still moving down.
Exactly. It shows the pressure is shifting.
It's kind of like a weather radar on a ship.
Yeah.
Having the radar doesn't steer the boat for you, and it certainly doesn't guarantee you won't get wet in a storm.
Definitely not.
But it calculates the barometric pressure and the wind speed to show you exactly where the storm clouds, like the resistance, are peaking, and where the clear skies, the support levels, are likely located.
That radar analogy captures the essence perfectly. These tools highlight probabilities, not certainties.
Right, they're just educational overlays.
Yes, to help a trader manage risk. And when an analyst applies these tools to NIO's current chart, they see something highly specific. The stock has stopped free-falling and is now consolidating near a strong support level of $4.77.
Let's dig into that term for a second. When VIP Algos or any charting tool highlights a support level at 477, it's not just a random line on a graph. What is the actual psychological mechanism happening at that price point?
A support level is the exact price point where historically the pain of selling becomes greater than the fear of holding, and buyers finally step back in.
That's the floor.
It's the floor. It's where value investors look at the company and say, okay, this is too cheap to ignore. But the real tell that a support level is holding isn't just the price, it's the volume.
Right, the trading volume.
Yeah, and right now, NIO's trading volume has dropped to 0.6, 4 times its 3-month average.
Volume is drying up.
Oh.
If you're on a trading floor, it's suddenly crickets.
Exactly. And the sheer lack of volume is actually the most bullish signal on the chart right now.
Wait, really? Why is low volume bullish?
When a stock pulls back 25%, hits a support level, and the volume drops to almost half its normal rate, it suggests the selling pressure is completely exhausted.
Ah, I see.
The weak hands, the retail investors or algorithms that panic sell at the first sign of a drop, they're gone. The people holding the stock at 477 are the long-term believers who refuse to sell, and the sellers simply have no shares left to dump.
So the chart says we're at the floor. The fundamentals say the business is booming. So what provides this spark?
The catalysts.
Because a stock can sit at a support level for years if nobody cares about it. What is the catalyst that forces the market to wake up and reprice this thing?
You have to look at the catalyst calendar, and there are several massive elements converging right now.
Okay, what's first?
First, the dominant news sentiment has violently shifted. It's highly bullish right now, almost entirely due to the ES9 success.
That makes sense.
The media narrative has flipped from China EV slowdown to NIO's delivery boom, which starts bringing retail attention back to the stock.
I need to interrupt that bullish narrative for a second, though. Because I'm looking at the insider moves, and they are flashing a bright red warning light to me.
Ah, the insider selling.
Yeah. Over the last 90 days, company insiders had a net sale of 350,000 shares. There were 3 insider buys, sure, but 6 insider sells.
Right.
If the ES9 is such a guaranteed home run, why are the executives dumping 1/3 shares into the open market?
I get it. Insider selling always induces panic, but we have to analyze the timeline and the mechanic of executive compensation here.
Okay, talk me off the ledge.
The stock recently hit a 52-week high of $8.02 before this recent 13-week drop, right?
Right.
When a stock hits a yearly high, executives who receive a massive portion of their salary in restricted stock units routinely sell to cover the taxes on those very shares or simply to diversify their portfolios.
So they have mortgages and tax bills just like the rest of us.
Exactly. Taking profits near a 52-week high is statistically normal behavior.
Okay, that's fair.
And what's actually notable here is that there were still 3 insider buys during the same 90-day period.
With their own cash.
Yes. Seeing executives buy shares on the open market with their own cash is a rare and powerful signal of confidence. So the net selling doesn't really invalidate the reality of the ES9 delivery ramp-up.
Okay, assuming the insiders aren't just abandoning ship, what are the actual hard calendar events that could move the needle?
The absolute focal point is late August 2026.
The Q2 earnings.
Precisely. That is when NIO reports their Q2 earnings. The entire market is going to be hyper-focused on one metric. Did the 10,000 ES9 deliveries actually improve their net margins?
Did the restaurant finally make a profit on the food?
Exactly. If that operating leverage we discussed earlier starts showing up on the balance sheet, and management raises their forward guidance for the rest of 2026, it forces institutional algorithms to reevaluate the stock.
So that's your primary short-term catalyst.
Yep, that's the big one.
And they have macro tailwinds pushing them forward as well. Because the global EV market isn't collapsing the way some legacy automakers keep claiming.
Not at all.
I mean, global EV sales are up 4% year over year in May 2026. And EVs now hold a massive 26% global market share.
The pie is still expanding.
Pie is expanding, and NIO is taking a larger slice of it. But I want to talk about the wild card.
The subsidies rumor.
Yes. There is this unconfirmed chatter about government subsidies in China. What are the mechanics of that rumor?
Okay, so the rumor is that the Chinese government might introduce subsidies aimed at standardizing EV charging in major municipalities.
Okay.
And they might base that standard heavily around NIO's battery swap model.
Wait, why would a government prefer a complex robotic swap station over just installing a bunch of standard plug-in chargers? That seems backwards.
2 very big reasons: real estate and grid strain. Think about ultra-dense cities like Beijing or Shanghai. You physically don't have the space for tens of thousands of cars to sit parked for 45 minutes while they charge.
Because everyone lives in massive apartment complexes.
Exactly. A swap station processes cars in 3 minutes. That vastly increases the throughput of a tiny piece of real estate.
And the grid screen.
Plug-in chargers draw massive, unpredictable spikes of energy from the power grid when everyone gets home from work at 6 p.m. and plugs in.
Oh, that makes sense.
Swap stations, on the other hand, charge their stored batteries slowly throughout the night when electricity is cheap and abundant. They act as a massive buffer for the city's power grid.
So if that unconfirmed chatter turns out to be true, it dramatically de-risks NIO's entire business model.
Completely.
Suddenly, their terrifyingly expensive capital expenditures aren't just a corporate moat. They become state-backed public infrastructure.
It would completely rewrite the valuation of the company.
That is a massive upside. But, we can't just operate on hope and rumors here. Every great investment thesis needs a brutal stress test.
Absolutely.
So what is the bear case here? What specific mechanics could cause this turnaround story to just collapse?
The most glaring risk is the hyper-competition in the Chinese EV market. It is an absolute bloodbath right now.
I've heard it's ruthless.
It really is.
Yeah.
Competitors like Leap Motor are operating on razor-thin margins. They are vertically integrating their supply chains and initiating a scorched earth price war to basically bleed out the competition.
Right.
They're even pushing aggressively into North America just to find new revenue streams to survive.
And this is where the thesis gets a little shaky for me. With competitors slashing prices just to survive, how can NIO withstand a prolonged price war while simultaneously burning billions of dollars on building these robotic battery swap stations?
It's a very valid concern.
Because if a competitor undercuts the ES9 by $10,000 and NIO is forced to cut their prices to maintain that $10K a month delivery rate, their path to profitability is totally blocked. That 15.7% gross margin just vanishes.
That is the nightmare scenario for the bulls. If the ES9 production costs don't scale down efficiently and they are forced to participate in a race to the bottom price war,
Then what?
then that negative 9% net margin is going to expand, their cash reserves will deplete, and they will have to dilute shareholders to raise more money.
So given that very real existential threat, how do analysts justify stepping in at $4.78? I mean, why catch a falling knife?
Because of the valuation ratios, specifically the price to sales, or PS ratio.
Yeah. Okay, break that down for me.
The market isn't naive, right? Institutional investors know all about the price wars and the cash burn, and they have already priced that worst-case scenario into the stock.
Oh, so it's already baked in.
Exactly. Despite the 50% revenue growth, NIO is currently trading at a PS ratio of just 0.75x.
Let's clarify that for everyone. A PS ratio of 0.75x means you are paying 75 cents for every dollar of revenue the company generates.
Precisely. For a technology or automotive company growing its top-line revenue at nearly 50%, trading under 1x sales is an incredibly distressed valuation.
It's super cheap.
The market is valuing their raw cash flow as if the company might go bankrupt tomorrow. Now, contrast that with their price-to-book ratio, which sits at 17.62.
Wait, a price-to-book of 17 implies the exact opposite, doesn't it?
Yes.
It means the market highly values their underlying assets,
Yeah.
their patents, their base technology, their brand ecosystem.
It's a massive discrepancy. There's high value placed on their intellectual property, but a rock-bottom valuation placed on their current sales.
That's fascinating.
And that leads to the final verdict on this setup. They give this a bullish score of 8 out of 10.
8 out of 10, okay.
Yeah, framing it as a highly favorable swing trade into those Q2 earnings in August 2026.
So just to be clear, we are not telling you to buy or sell this stock.
Yeah.
We're just analyzing the mechanics here. But the logic relies heavily on that risk-reward asymmetry.
Right, exactly. The 25% pullback and that 0.75x PS ratio indicate that the bad news, the fierce competition, the high infrastructure costs, it's all heavily baked into that 478 price tag.
The downside risk is known.
It's known and quantified by the market, but the potential upside.
The margin expansion, the ES9 boom.
Right, the operating leverage kicking in, the potential government subsidies, none of that is priced in yet. So for analysts, the upside potential vastly outweighs the further downside risk.
It's the very definition of a bullish divergence. The stock price is temporarily completely decoupled from the accelerating business fundamentals.
Completely decoupled.
We have a company hitting its stride operationally, producing high-demand vehicles, but a stock chart that looks like it got beaten into submission, finally resting at a psychological floor where the sellers have just exhausted their supply.
This perfectly illustrates why elite analysts blend fundamental business analysis, looking at operating leverage, gross margins, the BAS network, with technical charting awareness.
Like using tools to spot exactly where volume dries up at support levels.
Exactly. The fundamentals tell you what asset is undervalued, but the technicals tell you when the market is ready to stop punishing it.
We started this talk by thinking about a race car where the telemetry says it's flying forward, but it looks like it's moving backward.
Right.
If the upcoming Q2 earnings show that the ES9 margins are actually expanding and the cash burn is stabilizing, we might just see a violent realignment where the stock price snaps back to reality and catches up to the business.
And a repricing event like that happens fast, which is exactly why identifying these support levels before the earnings call is so critical.
Well, I want to leave you with a broader thought to mull over, something that extends far beyond just this August earnings report.
Oh, I like where this is going.
Think back to the mechanics of the Chinese grid strain and that rumor about government subsidies. If NIO's battery swap infrastructure actually becomes the standardized, state-backed norm in major municipalities, does NIO eventually cease to be just an automaker?
That's the million-dollar question.
Because if every EV on the road is forced to use their swap stations, do they just stop fighting the brutal, margin-crushing EV price wars altogether and instead become the indispensable, unavoidable gas station of the entire electric future?
It completely reframes the ceiling of what the company can become. Long-term, it's a massive paradigm shift.
It's definitely a fascinating proposition to watch unfold. Thanks for joining us for this daily stock analysis. Remember to subscribe, like, and comment underneath if you enjoyed the show.
And don't forget to check out the VIP Algos link down in the description if you want to look at these charting setups yourself.
Absolutely. See you next time.